Good morning, ladies and gentlemen, and welcome to today's webinar on basics of derivative trading and risk management, brought to you by TradeSmart and Pickright. My name is Siddharth Panjwani, and what I hope to achieve in the next 30 minutes is leave you with the language, just scratching the surface of what this topic is going to be about. On its own, this topic is very broad and very deep, but what I only hope is that in this short duration, I leave you with a sense of the direction of that you can take. So without much further ado, I'm going to dive right in and introduce the participants in this market, the structure of the market. Now, there are three main participants which provide liquidity in this market, and they all have different motivations. So the first participant are the institutional players, right? So these are the risk managers. Imagine the treasury department in Maruti. Now, Maruti being such a large enterprise has a huge exposure to, say, aluminium because of its manufacturing necessities. What they would like to do is reduce the volatility in the price of aluminum over the next 6 months. The only way to do that would be to enter a derivative position. So they can lock in the price of aluminum by entering the derivative market. Another example could be if you're a large agri producer or an agri consumer, and what you would like to do is lock into the prices of either your produce or your consumables over the next 6 months. Again, you can do this using the derivative market in the commodities. The next set of participants are the arbitrage players. Now, the most simple way of playing arbitrage is the cash future arbitrage. We'll talk about that later. But what the arbitrage players do is that they use the inefficiencies in the markets to lock on to some profit on a risk-free manner with high-speed algos, with faster machines, and so on. Now, as algos get more sophisticated and machines get faster, the opportunities for arbitrage will also keep on reducing. But so this is a never-ending cycle, though. So the third set of participants in this market are the retail players, that is people like you and me. And typically these are the speculators. What this set of participants does is it tries to find an edge in predicting the direction a particular underlying asset is going to take and try to profit off of that. So that is the third set of people which are effectively speculating and providing liquidity in this market. Now let's look at what derivatives can do for you. Now, essentially, when you enter a derivative position, what you are doing is increasing leverage in your trading book. Now, what does leverage mean? Basically, leverage means that if the underlying position, if the underlying asset, underlying stock or commodity moves by 1%, your derivative position could move by a multiple. So that is n% because of the change in the underlying, right? So for example, let's say that a stock is at 100 and there is a 5% change in the stock from 100 to 105. Your derivative position could actually have a 20% change. Similarly, if the stock falls down 5% from 100 to 95, your derivative position could have a different percent change, right? The next thing that derivatives does is that it provides a risk-reward framework along with a probability built in, right? Now, the nature of derivatives is such that there is always an expiry. There are, if you look at options, there are strike prices, there are implied volatilities, there are historical volatilities, and so on. But long story short, derivatives as instruments have a built-in implied probability of where a particular underlying asset is going to go. So if you want to use the information of what is implied in the prices of these derivatives, you can come up with a probabilistic approach in your trading, right? The third set is similar to what I spoke about the stock earlier. Derivatives can give you non-linear profits or losses. So if we go back to the same example, if a 100 rupee stock increases 5% to 105, your derivative position could actually increase 20%. But if the 100 rupee stock decreases 5% to 95, by expiry, you might find that a position is not, derivative position is not falling 5%, it could have fallen only 2%. So this risk reward, this P&L is non-linear, right? There is a kink in the curve, so to say. Right now, before you get started, if you're a newcomer to derivatives, I would recommend that you should at least be comfortable with what the infrastructure in the market is, what are the basics to get started in this market, right? First thing is that when you open your brokerage account and if you want to trade derivatives, you have to ask your broker to allow you to trade in the F&O segment. There is some paperwork involved. There are some forms that need to be filled and some agreements that need to be signed and so on and so forth. And these rules keep on changing from time to time. Right. Next, you need to understand what the brokerage charges are. So that is the brokerage that is charged by the broker. And on top of that, you have some regulatory charges, including sales tax or some other government charges. And these charges as well keep on changing from time to time. There could be new budget and new regulations which come in and so on and so forth. So you have to stay on top of them, and you have to sit with your broker and understand what are the economics behind buying or selling a particular, you could say, instrument in this market, in this segment. How much is the transaction cost, right? The third is that you need to understand margin. Now, what is margin? Margin is essentially what gives leverage to these instruments. So the best example could be now with the Nifty at around 12,000 and with a lot size of 75 shares in the Nifty, your notional value in the Nifty is about for one lot is about 10 lakhs. So that's the exposure that you're getting from one lot of the Nifty. Typically, the margin for Nifty is in the range of currently about 16 to 17%. So about 1.5, 1.7 lakhs is what you need to pay upfront in order to get that kind of exposure. So by paying about 1.5 lakhs, you are getting exposure to an instrument of worth 10 lakhs. So you can see where you're getting leverage here, right? This is margin. Now, margin is different for different underlyings. It could be different for Nifty. It could be different for specific stocks. So again, that is an understanding that you need to achieve. Finally, in the last year, SEBI has changed the settlement rules for index derivatives versus single stock derivatives. Earlier, everything was cash settled, both index as well as single stocks. Now they have changed the rule for single stocks to make it physical settlement. What it means is that on expiry, index derivatives can be settled in cash. So your P&L will be paid out to you in the form of cash, or you will have to pay out if you are making a loss. On the flip side, for single stocks, it is expected that you are either able to take delivery or able to give delivery of that specific number of stocks, which means that you should have the required inventory with you, or you should have the required capital to buy that inventory in the physical stock settlement process, right? Now let's look at futures, right? Now by the very name, futures imply that there is a time component involved in this instrument. What a future is that it is essentially a standard contract to either accept delivery or give delivery of a fixed number of shares of the underlying on the future. So when I spoke about the Nifty future earlier, and I said the lot size was 75. So now this is a standardized contract of size 75. What is the underlying? The underlying is the Nifty index, right? With the Nifty around 12,200 times 75 is about 10 lakhs. So that is when I say the notional, right? So the Nifty future essentially means that you are entering into a contract to either accept delivery or give delivery of 75 shares of the Nifty. Now, Nifty being an index, we don't have 75 shares of the Nifty because it's only an index. It's not a physical stock, which is why it's cash settled, right? If I'm talking about, say, Reliance, then the story is different. Reliance will have some other lot size. A Reliance future, you can either give delivery of Reliance shares or take delivery of Reliance shares. Now, based on the stock price changes of the underlying, there will be daily, say, cash inflows and cash outflows. So let's say that you buy a Nifty future and you pay the margin upfront, and the Nifty price rises by the end of the day, then actually the difference in the price since you bought it and by the ending price, that profit will be credited to your brokerage account. So that is a cash inflow. If on the flip side, if you have bought the Nifty future and the Nifty price falls, then by the end of the day, whatever is the difference between your buy price and the ending price of Nifty, that loss will be debited from your brokerage account. So you should have capital in your brokerage account to be able to meet that obligation. So there is a daily cash inflow and outflow. Now, margins are required for both going long and going short futures. This is for risk management purposes, for having, you could say, some funds available with the broker, so that because you're taking this risk, right? Now, in case of a future, typically there is always some price difference between the underlying position, that is the underlying asset, as well as the future price. Typically, the future price is at a premium to the underlying asset. And this premium, or sometimes it could be a discount as well, sometimes it could be the same as the underlying. So this discrepancy comes because of different reasons. The first is the interest rate component. Like I said, a future has a time component built in. Now, as soon as you're talking about time component, there is an interest associated with it. So instead of buying, say, 1,000 shares of Reliance, I can bet on 1,000 shares of Reliance by going long a Reliance future without having invested that much money in Reliance. I could instead keep that money in the bank and earn interest. So it's only fair to me that the future price should be at a higher price than the Reliance stock price. So that is the interest rate component that I'm talking about. The next is the price difference. Sometimes because the discount could also occur because of supply demand dynamics, and this is India specific a little because India is a market where we cannot borrow stocks and short them. Right? If you want to short a stock, if you want exposure to the price fall of a stock, you can only do it through the F&O segment. So sometimes if there is a lot of bearish news or bearish expectation around a particular stock or an index, you will find that the future price is actually below the underlying. The third reason of this price discrepancy is because of a dividend. If you're a stockholder, you are entitled to any dividends that are paid out by the company, right? But if you're a future holder, you are not entitled to these dividends. So if there is, say, a dividend that is upcoming this month, in the next month, you will actually find that the future price could actually be below the underlying stock price because of the dividend factor. If you're a holder of the stock, you will be getting the dividend. If you're a holder of the future, you won't be. So that price difference makes sense. Now let's look at the options, call options, right? Now, call option is a right. It's an option to buy a fixed number of the underlying asset at a particular strike price at expiry. Now, what are strike prices? Strike prices are essentially, say, fixed prices, fixed levels of the underlying asset that are decided by the exchange where these options are listed, right? So these are standardized, you could say, levels of the strike of the underlying asset where it is expected to hover. You can either go long or call option or go short a call option. A long option is the right or the option to buy. A short option is the obligation to sell, right, or deliver if the option is exercised by the option buyer. There is no margin that is required while buying the long option. Margin is only required while selling the short option. Generally, call options are used as proxy to get levered exposure to stock price rises. So if I expect, say, a particular stock to rally 10%, and I don't want to invest buying a lot of that stock, I can get that 10% rally by buying options, which will only be a fraction of what my capital required would be, right? However, when we are buying long calls, we have to be careful of the amount of premium that we are paying, right? The premium is, you won't get this option for free. Obviously, you have to pay something on top of the underlying price in order to get exposure to this option, right? If you pay a lot of this premium, then you might find that you're not making any money. So then if you flip the story around, if you are selling the call option, if you get very little premium, then you might not make money. You might actually end up with a lot of losses. And we'll cover this in examples later. Now, put options are the mirrors opposites of call, almost the mirror opposite of call options. A put option is an option or a right to sell a fixed number of the underlying asset at a particular strike price at expiry. We can either go long or short these put options. So long option is the option to sell, short option is the obligation to buy. No margin is required while going long the put option. Margin is required while selling the option. And generally, like call options, they are used as a cheap proxy to get exposures to stock price falls. So if you expect a stock price to fall 10% and you don't have, or you don't own that stock to sell, but you still want to participate in that direction down, you can buy a put option by paying the premium, and you can participate in that direction. So again, you have to be careful while paying very high premiums for long options, and you have to be careful while receiving very low premiums for short options. So that was all theory. That was all you could say understanding the basic. अभी examples देखते हैं, right? अगर आपकी conviction है, अगर आपको लगता है कि निफ्टी बढ़ने वाला है, तो आप कैसे पार्टिसिपेट करेंगे निफ्टी के राइज में? आप एक लॉट निफ्टी फ्यूचर का खरीद लीजिए. निफ्टी फ्यूचर का करंट जो लॉट साइज है वो 75 है. निफ्टी अराउंड 12,200 पे चल रहा है. मार्जिन रिक्वायर्ड अराउंड 1.5 लाख, एक्चुअली 1.75 लाख लगेगा मार्जिन रिक्वायर्ड. हर पॉइंट जो निफ्टी बढ़ेगा आपको 75 रुपीज मिलेगा, बिकॉज आपने एक लॉट खरीदा है निफ्टी फ्यूचर का। सिमिलरली अगर आपको लगता है कि निफ्टी गिरेगा तो आप निफ्टी फ्यूचर बेच सकते हो। आपकी फिर से मार्जिन रिक्वायरमेंट अराउंड 1.5 1.75 लाख होगी। हर पॉइंट जो निफ्टी गिरेगा उसमें आपको 75 रुपीज का प्रॉफिट होगा, बिकॉज आप शॉर्ट हो। सो ये आपकी इकोनॉमिक्स है फ्यूचर में, निफ्टी में। अगर आपको कॉल्स में से ट्रेडिंग करनी है निफ्टी कॉल्स में, तो अगर आपकी कन्विक्शन है कि निफ्टी बढ़ेगी, सेम लॉट साइज 75 ही है, आप लॉन्ग कॉल निफ्टी का खरीद सकते हो। आपकी जो इन्वेस्टमेंट है वो खाली प्रीमियम होगी, जो कॉल की प्राइस है वही इन्वेस्टमेंट आपकी होगी, आपकी मार्जिन रिक्वायरमेंट कुछ नहीं होगी। आपको प्रॉफिट तभी होगा अगर निफ्टी एक्सपायर होगा एक लेवल अबाव प्रीमियम एंड स्ट्राइक प्राइस। सो एज एन एग्जांपल, लेट्स से कि करंट निफ्टी प्राइस 12,200 है। आपको लगता है कि निफ्टी और 300 पॉइंट बढ़ सकता है, 12,500 तक जा सकता है, तो आपने सोचा कि ठीक है मैं 12,300 का एक कॉल ऑप्शन ले लेता हूं, उसका प्राइस अज्यूम करते हैं कि 50 रुपीज पे चल रहा है। आपको प्रॉफिट तभी होगा कि अगर निफ्टी 12,350 के ऊपर सेटल होगा, 12,351 पे अगर सेटल होगा तो आपको 1 रुपी का प्रॉफिट होगा, मल्टीप्लाई बाय 75 रुपीज का आपको प्रॉफिट होगा। So for every point rise about 12,350, you will get an additional 75 rupees. अगर निफ्टी 12,350 के नीचे सेटल हुआ, राइट, रादर 12,300 एंड बिलो पे सेटल हुआ, तो आपकी लॉस होगी, राइट। आपकी लिमिटेड लॉस है इधर। अगर निफ्टी नीचे गिरा तो योर ओनली लॉस इज द इन्वेस्टमेंट जो आपने प्रीमियम भरा है। अगर आपने रिवर्स किया, अगर आपको लगता है कि निफ्टी गिरने वाला है, कि ये बढ़ने के चांसेस नहीं है, तो आप ये सोच सकते हो कि मैं 12,300 का ऑप्शन बेच क्यों नहीं देता हूं, कॉल ऑप्शन 50 रुपीज पे। तो आप वो भी कर सकते हो। आप शॉर्ट निफ्टी कॉल जा रहे हो, आपको मार्जिन रिक्वायरमेंट होगी, जो आपको प्रीमियम रहेगा 50 रुपीज मल्टीप्लाई बाय 75, आपको क्रेडिट मिलेगा, राइट, वो आपको अपफ्रंट क्रेडिट मिलेगा जो प्रीमियम प्राइस है। लेकिन ऐसे पोजीशन में आपकी अनलिमिटेड लॉस की भी पॉसिबिलिटीज है। अगर निफ्टी सेटल होता है 12,500 पे, तो बेसिकली आपको 150 रुपीज का नुकसान है मल्टीप्लाई बाय 75। जहां पे भी निफ्टी सेटल होगा, अगर वो 12,800 पे सेटल हुआ, तो फिर आप गणित कर सकते हो कि 12,800 मल्टीप्लाई बाय 12,800 माइनस 12,300, उतना आपका इंट्रिंसिक है, उतना आपका नुकसान का पॉसिबिलिटी है। नाउ द रिवर्स इज फॉर पुट्स। अगर आपको लगता है कि निफ्टी गिरेगा, तो आप पुट ऑप्शन खरीद सकते हो बाय पेइंग द प्रीमियम। अगर आप पुट ऑप्शन खरीदते हो तो आपकी इन्वेस्टमेंट है वो लिमिटेड है, आपकी जो लॉस है वो लिमिटेड टू द इन्वेस्टमेंट है, राइट। आपको प्रॉफिट तभी होगा इफ the nifty settles at a price below the strike price minus the premium. So again with the nifty अगर 12,200 पे है, आपने 12,100 का पुट खरीदा at 50 रुपीज, आपको प्रॉफिट तभी होगा if the nifty settles below 12,050। अगर 12,000 पे सेटल हुआ तो आपको 50 रुपीज का मिलेगा मल्टीप्लाई बाय 75, दैट विल बी योर P&L, राइट। सेम अगर आपने शॉर्ट गए निफ्टी पुट, then you will require to post margin, because you as soon as you go short options, आपको मार्जिन भरना पड़ता है। जो आपका प्रीमियम प्राइस है वो आपको क्रेडिट मिलेगा। 12,200 पे निफ्टी चल रहा है, 12,100 का पुट आपने बेचा 50 रुपीज पे, आपको 50 रुपीज क्रेडिट होगा। अगर निफ्टी सेटल होता है above the strike price minus premium, basically if the nifty settles about 12,100 minus 50 or about 12,050, तो आपको प्रॉफिट होता है। अगर निफ्टी उसके नीचे गिरा, इमीडिएटली आपकी लॉसेस मल्टीप्लाई हो सकती हैं। दैट इज द रिस्क दैट इज इन्वॉल्व्ड हियर, राइट। नाउ हाउ डू यू पुट दिस ऑल टुगेदर? उसको आप रिस्क मैनेजमेंट कैसे करोगे? यहां मैं अनलिमिटेड रिस्क लॉसेस की भी बात कर रहा हूं। दैट इज वेयर आप कंबाइन कर सकते हो डिफरेंट इंस्ट्रूमेंट्स, फ्यूचर्स, कॉल्स, पुट्स, स्टॉक, ये सब आप कंबाइन करके नॉन लीनियर पे ऑफ अचीव कर सकते हैं डिफरेंट स्ट्राइक्स पे, डिफरेंट ये कुछ प्रोबेबिलिटीज के साथ। ना सबसे सिंपल जो होता है वो उसे कहते हैं कैश फ्यूटा आर्बिट्राज। सो फॉर एग्जांपल, आपके पास HDFC बैंक की पोजीशन है जो आपने 10 साल पहले खरीद के रखी थी। यू हैव 550 शेयर्स ऑफ HDFC बैंक लाइंग इन योर अकाउंट। आप कभी बेचने की इसको मूड में नहीं हो, आपको लगता है कि मैं ये कभी बेचूंगा ही नहीं, आपको डिविडेंड इस पे मिलते जाता है। लेकिन आपका एक तरीका है कि ओके, हाउ डू आई गेट एडिशनल इनकम आउट ऑफ दिस एसेट दैट इज सिटिंग इन माय अकाउंट। आप क्या कर सकते हो कि जैसे प्रीमियम दिखे आपको फ्यूचर में, आप 550, मैंने क्यों चुना है बिकॉज लॉट साइज ऑफ HDFC बैंक इज 550। आप एक लॉट HDFC बैंक का बेच दीजिए फ्यूचर में एट अ प्रीमियम टू द HDFC बैंक का प्राइस। एक्सपायरी पे ये प्रीमियम कोलैप्स हो जाएगा। सो जो कोलैप्स हुआ, लेट्स से कि आई एम जस्ट पुटिंग नंबर्स, लेट्स से HDFC बैंक अपने 1000 का अंडरलाइन चल रहा है, 1050 पे अपने फ्यूचर बेचा, 50 रुपीज का जो डिफरेंस है वो कोलैप्स हो जाएगा, वही आपकी प्रॉफिट होगी एवरी मंथ, राइट? सो दैट इज अ वे ऑफ जनरेटिंग इनकम। The other way of doing this is you can also sell out of the money call options, right? If you're sitting on the HDFC bank cash position, and let's assume that that underlying price is around 1000, every month you come in, आप 10% away out of the money call बेच दीजिए, तो जितना आपका जो क्रेडिट होगा ये कॉल ऑप्शन बेच के, that will be your income from that particular stock. The other way of doing all this and putting in strategies is कि आप लॉन्ग भी जाइए कॉल ऑप्शन, शॉर्ट भी जाइए कॉल ऑप्शन अलग स्ट्राइक्स पे। these are all बुल स्प्रेड्स, बेयर स्प्रेड्स, मैं सब टेक्निकल टर्म्स में इन्वॉल्व नहीं करना चाहता हूँ फिलहाल। अल्टीमेटली आप क्या जा रहे हो, या आप यहाँ तो लॉन्ग वॉलेटिलिटी जा रहे हो या तो शॉर्ट वॉलेटिलिटी जा रहे हो। आप कैसे भी ये सब पैकेज बनाइए। तो लॉन्ग वॉलेटिलिटी का मतलब यही है कि आप ये एक्सपेक्ट कर रहे हो कि बहुत बड़ी मूव आएगी। शॉर्ट वॉलेटिलिटी का मतलब यही है कि आप एक्सपेक्ट कर रहे हो कि मार्केट या आपके स्टॉक में ज्यादा मूवमेंट नहीं आएगी। अल्टीमेटली आप यही कर रहे हो, राइट? फाइनली देयर आर लॉट्स ऑफ डिफरेंट रिस्क्स इन डिफरेंट डेरिवेटिव इंस्ट्रूमेंट्स, राइट? आपकी डायरेक्शनल रिस्क है, आपकी स्पीड रिस्क है, आपकी जो टाइम डीके की रिस्क है। अगर आप हर रिस्क को हेज करें तो आपको फाइनली मिलेगा रिस्क फ्री रेट ही। तो आपको कंफर्टेबल होना है कि आपकी एज किस में है, आपकी स्पेशलिटी किस में है, क्यों, कौन सी रिस्क को हैंडल करने में है, एंड अकॉर्डिंगली आप अपनी डेरिवेटिव पोजीशन बना सकते हैं। नाउ ये सब ट्रेडस्मार्ट और पिकराइट कैसे आपको हेल्प कर रहा है? नाउ ऑब्वियसली ट्रेडस्मार्ट इज वेल नोन इन द ऑप्शंस कम्युनिटी फॉर इट्स ब्रोकरेज, for its low brokerage charges as well as its technology and the facilities that it provides to the derivative market players. And Pickright क्या कर रहा है, एक प्लेटफॉर्म बना रहा है जहां पर ये आइडियाज आपको हेल्प करते हैं इन ऑर्डर टू एंटर दीज पोजीशंस, राइट? तो जो मैं आपको एक स्क्रीन पे दिखा रहा हूं, ये एक स्ट्रैटेजी है जो पब्लिश हुई थी अगस्त में। वो स्ट्रैटेजी ये थी कि बाय TCS 2380 का स्ट्राइक एंड सेल TCS 2420 का स्ट्राइक। तो जब ये एंटर हुई थी स्ट्रैटेजी, ये 2200 की थी। दैट वाज द इन्वेस्टमेंट रिक्वायर्ड टू एंटर द स्ट्रैटेजी, एंड दिस इज आल्सो द मैक्सिमम लॉस पॉसिबल फ्रॉम द स्ट्रैटेजी, राइट? जब ये एग्जिट हुए थे, जब ये टारगेट हिट हुआ था, तब ये प्रॉफिट था 12,000, राइट? तो आप देख सकते हो कि 6 टाइम्स ये पोजीशन की वैल्यू हो गई थी बेस्ड ऑन द मूवमेंट इन TCS. So these are the kind of ideas that you find on the platform, and basically if you are a newcomer, you can use these ideas to start on your journey in this market.